Good afternoon, everyone. I am Rana Ravi from MSME and Startup Committee. Today, I would like to welcome our speaker, sir, CA Nakul Arora, sir, and our moderator, CA Chandni Rathor, ma'am, for today's Pathshala series. Ma'am, over to you.
Good afternoon, everyone. On behalf of MSME and Startup Committee of ICI, see Chani Rathod extend a very warm welcome to all the esteemed members and participants joining us today. MSME Pathshala Series 96 on the topic The Four Capital of Every Business. In today's dynamic business environment, financial capital alone is no longer sufficient for sustainable growth. Successful enterprises are built on combination of multiple capitals that are driven by creation, resilience, and long-term success. Through this insightful session, we will explore these four capital and understand how business and professionals and entrepreneurs can leverage them effectively. We are privileged to have with us C. Nakul Arora sir, a distinguished professional and a speaker who will be sharing his valuable insight and practical experience on this important topic. Now, I would like to formally introduce our today's speaker, C. Nakul Arora sir. He is a chartered accountant, corporate trainee, keynote speaker, and thought leader with extensive experience in professional standard, taxation, auditing, business analytics, financial wellness, leadership development. He's founder and managing partner of a CA firm and has established one of the most sought after speaker across professionals and corporate platforms. With an impressive track record of delivering 900 plus technical session plus 350 plus soft skills and leadership development program. CA Nakul Arora sir has inspired professionals, students, entrepreneurs, and corporate executives across India. His sessions are known for combining technical excellence with practical insights, making complex subjects simple and engaging. A qualified chartered accountant from ICI, he possesses deep knowledge in accounting, auditing, taxation, financial management, professional ethics, quality control, standards on accounting, business analytics, and strategic financial management. Over the year, he has addressed audience at numerous ICI branches and professional forums across the country on the topics including professional ethics, quality control standards, technical and professional compliance, business analytics, financial wellness, corporate market and investor awareness, audit planning, communication, leadership, and interpersonal effectiveness. His corporate training portfolio includes engaging with reputed organizations, CISF, Barco, Visit Healthcare, Policy Bazaar, One Card, Savila, Sexo Bank. Beyond technical expertise, K. Nakul Arora sir is also widely recognized for his contribution in personality development, communication skills, interview preparation, conflict uh, management, leadership training, etc. And again, there are more key highlights to his profile. I think, sir, you have such an amazing profile. We should take another session to get more insight from it. He is financial wellness for CSF, wealth management for various companies, compliance with technical and professional standard ICI with Mumbai, Delhi, Faridabad, Rewari, Jammu, Gwalior, and Dehradun. He has delivered various sessions for compliance with ethical standard in Vadodara, Rajkot, Noida, Srinagar, Prayagraj, and Aligarh. Standards on quality control and audit documentation on Guntar, Dhanbad, Panipat, Ratlam, Mathura, Bhatinda, Patila, and the list goes on. So, in short, we have got a very amazing speaker with us today, and I request everyone to take the complete advantage of the session. So, during the session, if you have any doubts, you can put it in your question bank, and we will try to resolve as many as possible at the end of the session. So, with warm welcome, I would like to pass on the dice to our esteemed speaker. Over to you, sir.
I think you created a premise that will be really hard to justify. Given so many big words to me, so I'll try the best I can, of course. But To begin with the session, it's only fair that we give our warmest regards to the Institute of Chartered Accountants of India, the chairman of the board, CA Gyanchand Mishra, the vice chairman, CA Sanjay Agarwalji. We've got Rana Ravi from the board with us, and we have the secretary, Shanu ma'am as well, who has created the entire system wherein which we are able to interact with not just the CA community, but I think we have people from the business teams as well. Before we're going to begin into the technical part of the session, and I'm really sorry to the audience, but it will be a little technical because, I have personal belief that if you cannot put it into math, it is not yet accounting. So if there's no mathematics working, subjective things can be analyzed, but when math speaks, I think the universe is speaking to you. So I always say accounting is the work of God. So the only way universe talks to us is, I think, through mathematics. So I try to make sure that even if it is extremely subjective, let's find matrix and justify it with mathematics. Before we begin, I would ask simple questions. Because we are in a webcast, we will not be able to do Q&A, but I would want you to sit wherever you are and try and ask this question to yourself so that you get into the current position, where I'm coming from. The question is simple: why do some businesses survive major crisis, be it COVID, it could be a lockdown, it could be a war happening between two countries, no, war happening within their country as well, they're able to survive collapse despite having similar products, same markets, sometimes even similar financial statements. The other businesses are collapsing, but some are surviving. So, over the next 2 hours, I want to propose that every business has two balance sheets. Just like you can see on the screen, the first one is visible, the second is the invisible one. And the invisible one usually decides the future. So, as you can see on your screen, the balance sheet, you can see the asset and liabilities, the profit, the loss, they will tell you where you stand today, or at least what happened last year or a few years ago. But this part can help you predict tomorrow. And today, we'll not just learn about this, we will convert this into actionable mechanisms where you're able to take action on that. Not just read about it, have feelings about it. Feelings don't convert into money. That's what I've always felt. So let's try and convert this into actionable mechanisms. Well, the question starts from, because I'm an accountant, so I think like an accountant. So every businessman has a right to think from their perspective. My perspective became that, so there are always, every accountant that you are dealing with today, your personal accountant, your company's accountant, they all are able to ensure compliance. Yet, a few are changing trajectories of the business upward. There's only a few of them, but what is it that they're doing different? Look, everybody knows we are supposed to look at the business from a point of view of profit. We all know that there has to be less credit period is more profit. But when number of business is so much, and today we are living in the age of information. With so much of information, one thing happens that you have to be more and more precise with every passing day. So moving further, what happens is, so what you record is visible, what sustains you is usually not visible. I have a very important thing I tell my clients, my business colleagues, everybody, and friends who from business, that the cues that business gives, the signs of something negative is very subtle when you can do something. But when everything has collapsed, it becomes obvious. So we cannot say that, okay, I'm not getting the right feeling, I'm not getting the right push, because when the push comes, it's already too late to do something about it. So we're gonna take subtle clues of the business today. So, like I said, they have become irreversible. The business has already collapsed. I'll give you an example. So, one of my clients was not a client. We were just having a meeting, and we went to meet this person. And he said that I'm trying to look at unit economics. I'm trying to convert my business into profit. Like, we're trying to turn the wheels around for better this time. And the position was that he started his business with a 20 with a 30 cr loan. After 10 years of working, the loan was 20 cr, and he had some assets here and there. A marginal increase of approximately 12 to 13 crores was there in the balance sheet. But what he did not express that 2 years ago they had to sell a few properties, a few houses. When I put that impact into the balance sheet, the erosion of assets was more than 70 to 75 crores, and the balance sheet was total weighing around 30 35 crores. So a 100 crore person has become a 30 crore person. You cannot spend that kind of money in 10 years unless you are reckless. And he was not a reckless person. But when he told me, I said, you can think like you're starting a business from a starting point, but now the damage is done and we have to think from a future perspective. But if we had caught this 5 years ago, we could have done something much better about it. Moving further. So these four capitals are holding your business. We tend to believe that we know a lot about it, but what the balance sheet says is only approximately 15% of what you will do, what exactly it is trying to tell you. Then we have trust, human, and knowledge. We all understand the words, and we can understand that trust capital means the reputation that we hold, human means more of our employees, and knowledge means the systems that we have developed. I'm not going to bore you with the theoretical concepts today. I'm here to make sure I have given you engagement. I have to give engagement to your thinking, and we have to create a much better proposition for yourself. When you go back, you should have a special, a special belief that what exactly we have learned so far and how exactly we are, planning to move further. More business failures become irreversible when they're visible. So, like this debt trap, this customer dependency, you're already dependent on a large customer. Now, there's nothing you can do about it. Founder dependency is there. You cannot create systems in overnight. And if once you start creating systems, people start feeling detached from the founder as well. The loss of knowledge happens a lot of times. So by the time financial statements reveal the problem, the business has usually been suffering for years and years now. Moving further, so the four capitals that I was talking about is that these are four pillars, and this structure is standing on them. You remove one of them, people think business will collapse. No, one pillar does not collapse the business. Sometimes not even two. But the problem with one pillar will start slagging the business down. Ultimately, all the problems have to come here. Any problems that are being derived anywhere have to come to this point. A financial failure will tell the person that the failure has happened. So the question is simple. How many people in the audience have seen a business collapse ever? If you're chartered accountants, 100% you have. Even if you're not a chartered accountant, you're into business, you're a person of employment, you have seen businesses collapse. We've seen businesses collapse left, right, and center. I'm not going to ask you the names. I'm going to give you 4 or 5 case studies to relate with this. And the second question is, how many we have seen that business was extremely weak, but that has survived? Now, this is 100% for chartered accountants. Maybe if you're not into accountancy, I'm sure 70 to 80% of you have seen businesses who were weak, but they ultimately ended up surviving. That is exactly what today's discussion is. We'll talk about facts and not opinions. I said we'll be in numbers. Don't analyze anything right now. Just read the facts. Okay. So this is Kingfisher Airlines. We all know Kingfisher Airlines. Lesser known fact is this 2005 to 2007 story. And I'm talking about people who are new to the business, who were not active accountants during this period. They must be wondering what exactly happened. So it was a premier full service carrier. Just like in India, used to have Air Vistara, we have Emirates, with big airlines. It was a premium with a full service carrier, has a business class, has extremely well lit services, meals included in all the plans, things like that. It was a premium service provider. But then, for rivalry or maybe competition, it took over Air Deccan. It was a low cost, but it was a rival. Like today, we have low cost carriers in India as well. The losses of that carrier plus the borrowings that they had to do to make this acquisition and stuff, they mounted steadily. They didn't mount suddenly, they were mounting steadily for these 2008 to 11 4 5 years period. Then the flights had to be grounded, salaries remained unpaid. So you see what happened. Initially the knowledge capital took a hit. Then, of course, The financial capital was taking a hit. Suddenly, you saw that human capital also took a hit. And finally, the flight license in 2007, 2013 was allowed to lapse. That was the level of failure. So, what do we learn? What failed here? Well, the liquidity. Cash ran dry long before the brand did. So we were seeing Kingfisher as a big brand. We were seeing parties happening, everything going good, but the cash was already gone. So there was no cash in the books there. There was fresh borrowing was only funding the existing losses at that time. The expansion outran the economics beneath it. So whosoever was designing this expansion did not do the math right. His mathematics failed completely. Moving further, we have Nokia. Many of us know Nokia as the world's largest mobile phone maker around in the 1990s. In 98, it was the largest mobile phone maker. But in 2007, what happened is iPhone redefines what a mobile phone actually is, what telecommunication will be, what we see today. But until 2010, again, similar period, 8 to 11, 8 to 10, so similar period to that, they stayed committed to Symbian. Now, many of the young folks in the audience will be asking, what the hell is Symbian? So, what platform does your phone use? I'm really sorry we cannot even chat right now, but your phone is either using iOS as an operating system or it is using Android as an operating system. Symbian was a very good operating system until Android came in. So around 2007, when iPhone brought iOS, at the same time, Symbian was the old system, Android was the new system. Now, at this time, Nokia did not move to Android as quickly as it should have. If you remember, Nokia was launching Windows operating system phones until very recently, if I remember correctly. So yes, 2011, sorry, it was Windows Phone which it launched. And in 2014, the entire unit was sold to Microsoft. So what failed here as well? Again, the same thing. Mastered a game that was already ending. What was it? It was a hardware led. The software was not very important. It was mastering the quality, voice quality, audio quality, and stuff like that. But no, it was game was ending. Hardware led ecosystem fell behind and it saw the shift. Android would have approached Nokia. Nokia would have known Android is coming in. They had an R&D team, but adapted far too slowly. Wrong adaptation. Moving further, the codec. If you have been a young child in India in 2000 until 2010 as well, 5, 6, you would have seen codec cameras. KB10 was the first camera of many of us in the audience. Maybe whosoever is my age, they would have had the KB10 as a camera as a child, the first camera that you hold in your hands. So the first digital camera was invented in 1975. Until 1990s, it dominated the film, paper, and chemicals industry. In 2000s, digital is shelved. Why? It had a digital camera, but it discontinued it because it wanted to protect the film industry, the film on which the photos were being recorded. And it discontinued the iconic Kodachrome. It was a very famous camera at that time, but only in the next 3 years it filed for bankruptcy protection. Now again, the question is same: what failed here as well? Well, they feared their own digital future. This is called self cannibalism. It was seeing itself as a film company and not as an imaging company. The identity, you all running a business, you running a CA firm, you have an identity. You need to protect it with all your might. The timing, it pivoted to the different industry only when the window has closed. So this is the point I'm warning you about. So if you are thinking that these numbers are not for me, I'll do it later, maybe these are not there, the signs that your business is showing is so subtle, my friends. I promise you, you've not seen what can be coming in future. So that's important to do these analysis. Again, let's see some success stories now, not just failures. Let's see some success stories. Well, Toyota production system was made in 1950s. In 2008, the recession period, the global recession, the auto industry was shaken. and a recall had to be made. The crisis was there. Lines had to be halted. But it halted lines and openly owned the faults that were happening. Afterwards, it recovers as the world's number one automaker. We all know Toyota today. Toyota, we got Toyota Fortuners, we got Toyota Innovas in our country, we got Toyota Hycross in the country, we got many cars from Toyota. Now, what was going good in Toyota's case? Similar to the wrong mistakes, some people have the right things to do. It had systems. So its knowledge capital actually absorbed the shock. There was discipline in there. Trust capital. Instead of hiding the recall, it owned the recall. So it invested in the trust capital. They had reserves. They had reserves. So their finance capital was doing well as well. So that's where success stories begin. Now, profit on paper is not profit in the bank. This concept I started using from the time I was consulting one of my clients who was into a, you can call him a super stockist if you want to, because I cannot use the right words, I cannot reveal identities today, but he was a guy who was dealing with great numbers. 100 200 cr was his turnover. The only thing going wrong was that his his margin was 0.5% of the entire sale. That means if he made a 1 crore sale, the only profit that he used to make out of that 1 crore was a commission that used to come from the company where he was the agent, was 50,000 rupees. The problem here was that he used to purchase this product in advance and sell this on credit. So advance purchases meant he paid for the product around 1 month before he received them, one another month, so 2 months before they were sold, and around 5 months before he actually was paid. So for 5 months, the lowest interest that he was paying, or maybe I should go for the highest, but I'm going for the lowest, was 14% at that time. But I'll leave the 14%. I think a good loan in this country can be anywhere around 10%, right? So if I don't compound it and I just give you a monthly figure, it's a 0.8% per month is the cost of capital. This into 5 was his cost of this 5 month affair that was running. And his credit adjusted earnings. So this is what I call credit adjusted earnings. Whatever you earn from particular transactions before working out your entire balance sheet and looking for profit and loss, we need to work our day-to-day transactions and adjust the credit that we give and the time that we hold the bloody product. That's exactly strip out sales not yet collected and the profit shrinks. I'm not saying you don't recognize them. Many people do something very strange when I tell them they do cash accounting. Cash accounting is not the solution. Cash accounting is just a way of, presenting. But what exactly is happening here? 5 months of credit advance you're giving to whom? You are giving a 5 month credit advance. You're just funding the growth of the company who's made you an agent. So that's where exactly things trying to get south. And that's what I felt. So these are the cases where cash is going down, revenue seems up. The question is simple. If I say I'll give you 10 crore in revenue, you're a CA firm, okay? You're a business. If I offer you 10 crores in revenue, would you want it right now? I'm sure most of you have said yes to that. Sorry, my phone was silenced. Just give me 1 second. All right. So if I give you 10 crores revenue, you'll say yes. But as I told you, 0.5% margin, 90-day credit, 2 months of advance payment holding and stuff like that. It's just, you're just making losses for yourself. And even if you say, I have my own capital invested in the business, I'm not really in the favor. Because even if it's your own capital, and some days you are crushing yourself to the point where there's no other advantage. Now, I'm saying that there could be other advantages, but you have to see what that other advantage is, right? So, let's conclude whatever we've discussed. Sometimes not selling is better than selling. Remember these words, sometimes not selling is better than selling. Let's talk about the mechanism we'll discuss today, the IBT 300 framework. So what happened is I became interested in a question very strongly, that what if we could measure invisible strengths before they became visible failures? And like I said, I love to measure things. I love to bring it into maths. It's a work of God if it's math. If it's just theoretical, you know, if we are giving opinions based on what we feel, it's we playing God and not God talking to you. Maths is a way of God's talking to us, right? How about I take you away from the slideshow for a few minutes now? We've seen the slideshow for some time. We will get back, but before that, I will share something very important with you. I am introducing the IBT 300 framework to you. If my moderator or the institute is available, they can just confirm that they can see the book opened instead of the presentation now.
Yes, sir.
Thank you very much. So, every business has four capitals. I'm going to give this 50-page guidance note away after the session. You'll get this, every one of you. I'm also telling you how to go about this. So this booklet, I've tried to be as expressive as I can. So we can see that the contents of this booklet are divided in four parts. So we've got five different mechanisms of calculations. These are five different mechanisms of calculation, and these are the names. There's a liquidity strength index, credit efficiency ratio. Now, I'm not saying that these are available in any text. These are things which I've created from my research. So I have also given you the derivation and illustrations that how will these work. So like you can see, the lambda, which is the liquidity strength index. Let's start with understanding what is the first important ratio that we'll talk. Okay, this is things that I've already been talking to you about. So you can easily go ahead and believe that these are the things you've already discussed, but I've just tried to be illustrative about it. Now, the first index which we'll talk about is lambda. It is liquidity strength index. And the question is simple. What are we trying to answer is, can the business fund its operating cycle without distress? So if tomorrow revenue stops, where is the next rupee coming from? A real business surviving using a liquidity ecosystem, these are consisting all the items he can use in the situation of distress. I am actually trying to predict a liquidity failure or a complete failure down. So I'm saying that there is cash, there can be bank facilities, you can take trade credit if it's necessary at times. Customer advances are possible in practical business. Promoters can support corporations. There are liquid assets. So there are some assets which I can sell at any point. Maybe it is holding, maybe it is artifacts, maybe it is paintings. There is something I'm holding just to sell. The question which has been asked from generations is, how much cash do we have? I'm changing is, if revenue stop tomorrow, where would our next rupee come from? So if you see, first of all, we'll calculate the available liquidity pool. We have given weights, like cash is 100%, so one weight is given to it. The bank facilities, of course, there can be different issues or different charges or different reductions which can come there. So just a small 0.9, 90% is the weight of bank facilities. Then, of course, credit comes with interest, 80%. Advances again 80%, because getting that credit is a questionable situation. Promoter support is 60%, because promoters will support, but provided how much confidence they have in the enterprise going forward. Liquid assets, when you sell in distress, assets automatically lose half their value. So we win 40% weight. You can dynamically change these weights. So I calculate the available liquidity pool. Then we have the LDP, the liquidity demand pool. So what are the commitments that we have? We have operating expenses. Even if the revenue has stopped, we are not allowed to sell from tomorrow. We have to pay salaries, we have to pay rent, we have to pay electricity, things like that. There is working capital requirements. So you might have stopped sales for 3 months, 4 months due to distress, economy, export restrictions, tariffs, whatever. You will need working capital to continue production so that you can sell whenever things open up. There will be some commitments of expansion which are always there. At least salaries have to be increased with inflation, even if your revenues are taking a hit. We have to service our debt no matter what. So this is your liquidity demand pool. You can expand this pool, you can reduce this pool purely or based on your personal convenience. After you have the ALP and LDP, once you divide the ALP with LDP, you'll get the lambda, which is the liquidity strength index. My questions are very clear because ultimately we have to divide it into distressed, vulnerable, stable, resilient, strategic optionality. So my question is not that we are trying to cover up for your we're trying to get answers to the questions. We have to define the. I've made my interpretations very clear. If you have some questions as an accountant, you want to interpret it differently, you want to adjust it, of course you can adjust it because it's not a full-fledged mechanism which has been approved by an organization. This is a personal research. This is one-person research. You can always bring definitions to it. You can always refine this. So if I've given you this option, there will be scores which will be attached to it. So 0, zero point 0.1, zero point 0.5. Ultimately, there are 20 different metrics. You'll get a score approximately higher side of 40, starting from 0. So a score, we're not trying to score ourselves to get to our current position only. We have a better thing to do, that we put the scores we are scoring in the last few days and put it on a graph. So IBT 300, how does the name IBT 300 happens? The invisible balance sheet tool 300 is simple. It is 30 days. Every 30 days you make this calculation. You do 10 cycles, 300 days, and you just observe your graph if you're going higher or lower on this. Right? So there's a small illustration here. You guys can perform the illustration and get to a better answer. I'll not take a lot of your time, so I'll move on to the next PSI, which is my next, which is credit efficiency ratio. Now, it's not just about, like I said, adjusted credit, adjusted profits. I'm just talking about in the previous slides. I talk about credit efficiency as well. So there is profit after the credit cost. So there is always profit from making transaction, which is after the cost of credit. And this is how you calculate the cost of credit. And if the credit efficiency, like if the credit adjusted profit is 1, which is only possible if you charge, if you have only cash sales or advance sales. If 20% is consumed by credit, it is still fine. The red zone is, I have seen businesses going beyond the profit they make, and the credit cost is exceeding them. And this is very common for legacy businesses. I'm warning you. Startups can have this problem, but startups have bigger problems. MSMEs, which have been there for generations, you guys are consulting MSMEs, go and check their credit adjusted cost of the credit adjusted profit that they are making and divided by profit. You'll be surprised how many of them are operating at 50%. Like 50% of their profit is actually being consumed by credit. They are not businessmen, they're just fancy lenders. Businessmen are being used as fancy money credit schemes. So this is how you calculate it. Again, it's simple. I'll give you the illustration. I've taken the illustration of a very old client which I had. 10 crores was the revenue, 5 lakhs is the profit. But credit period is 90 days, 12% is the cost of credit, 29.6 lakh is the cost of credit. So credit adjusted profit is 24.6 lakhs. Right? So my PSI is 4.92, which is excellent or bad? It's bad because it is negative profit of 29.24.9. So it is less than zero. Minus 4.92 is less than zero. So I am only making 5 lakh rupees, but I am spending 29.6 in credit cost. So, what I said, there's always a key insight. Turnover is vanity. Credit adjusted profit is the reality. Turnover is vanity. So, just seeing the just there's a lipstick on a pig. That's it. So, how about we just move ahead and learn more ratios about today? This this is only financial capital we're talking about. We're only the third metric of financial capital. It's metric F3, 2-year economic dependency ratio. So this is how much we are dependent upon top customers. Now, I have a very different opinion here. Many people say that it is very common, very large. In India, what we see is the large customer is actually not just your largest customer per se, he or she is also your largest exploiter sometimes. So he has a very large credit period, he has a very bad negotiated rate, you have a very small margin, large credit. So what I ask you to do is to give yourself a break. How about you take the top 5 customer and don't take their profit? In my books, it is credit adjusted profit. So take the credit adjusted profit you make out of them and then take the total credit adjusted profit. So if more than 20, if less than 20% is coming from omega 2, if more than 20% more than 80% you're calculating from omega 2, it is fine. 20 to 40 is also there's a risk to growth, but you're okay, you're surviving well. Around 50% you'll have dependence, and above 60% from one is a survival risk, and after 80%, you're just a customer owned business. I'll put it in better words. You're just fancy employees who have been given a task to manage a particular function for a person and is allowed to do a few things on the side. That's the current condition of your business. If that is one person game. So, and this is a big warning which I give to cloud kitchens, to people who are working only for one app and calling themselves employed, self-employed. You can call yourself self-employed, but you're employed by this one particular brand. Franchisee owned stores. If you're running franchisee owned stores, you're also completely customer owned business. You're not owned by you as a proprietor, you as a founder have a very small participation in a business where there is somebody else calling the shots. And in an 80% dependency, customers are usually calling the shots. And you've seen these things. I promise you, you have. I've seen CA firms where they have a big client and they're totally dependent upon them. I've seen them sitting in their offices more than their own offices. I've seen them saying no to clients, even if they're good paying clients, they've got good business. CA has the knowledge to deliver, but he's saying no, right? Right? Why is he saying no? The question answers very simply itself that because they don't call the shots. Their one big customer is calling most of their shots. So, I'm giving you a small illustration. There's a customer who contributes 3 crores at a 0.8% margin with a 150-day credit period. So revenue analysis says it's an important customer. Economic analysis says it is a capital consuming customer. The biggest customer is not always the most valuable customer. In this analysis, I promise you, you'll have a surprise for yourself. Sometimes you're calling somebody your biggest customer means your most valuable customer. I say that's not the true case. Yes, there is one additional thing that the biggest customer might be giving you. It is the better economics with the vendors because you have larger orders, so you're getting better rates. But don't just say that is what you feel. Just try and calculate it. If it is actually true, is the difference you're getting from your vendor worth, is it coming to your pocket or is it again being consumed by your largest customer? Moving further, we have metric number 4, which is, sorry, metric number 4 is growth stress efficiency ratio. This is more about your growth. It is okay. You can see it's signified by gamma. So Is growth strengthening the business or is it weakening it? I'm so glad you're not. If you guys are pulling your hair, if you're scratching your head, you're at the right place at this moment. If you're sitting without a pen and paper enjoying a session, trust me, you're not getting anything out of today's session. You should have a pen and paper, doing calculations, finding mistakes, calculating the errors, refining the formulas for your clients. And trust me, this is the business line that will give you the most customer engagement in the future. And if you are a business person, trust me, start calculating this today. So, what is the growth stress efficiency ratio? So, first of all, let's find the incremental credit adjusted profit. So, I said everywhere we'll do profit is credit adjusted. So, how much incremental profit you have made? Then, how much stress have you put on the capital? So, capital stresses, how many receivables have increased, how much inventory you have to hold. Now, again, you don't write inventory, you write the cost of inventory here. Then what working capital requirements have increased and how much borrowings you had to do because of that. Borrowing cost, I'm talking about. This stress on capital against this profit. So this is the profit, this is the stress that you're putting in. What happens is sometimes we go ahead and because what happens normally is even whenever people have seen that what is that data called? CMD data, right? CMD data, CMA data. People only do it for loans, and many people just go ahead, fill in a formula format, and just go and present this to the banker and get their loan out. Now that is not for the banker, to be honest. That is for yourself. So every time you buy an asset, your cost of capital, sorry, your return on capital employed is changing. So, what is capital employed return is if I put, I'm doing this for the business people, I'm sorry, accountants, you already know this. That if you're putting in 100 rupees in the market today, if I'm putting 100 rupees out of this pocket and I'm putting into the CA firm, what more is it generating out of it? Otherwise, why am I not keeping that 100 rupees back there? And why is it important? Because I'm surprised to tell you that many times I've seen people investing more in business, expanding their business, and ending up consuming capital instead of creating more profit. Because what happens is they get money, they go bigger on operations, they get a bigger borrowing, and suddenly they start distributing credit period to increase the turnover. But come on, people are not there for you. Are they for your quality or are they just for the credit period? Right? Okay, so let's interpret this. If your gamma is more than one, you're at a healthy growth pace. So you get more profit than the stress that you put on capital. That means it is a positive issue. If it is equal to one, it's okay, it's healthy. Zero is a slow growth zone. So slow growth zone. There will be growth even if it is a little above zero, because yes, you are having a positive factor, right? So that means you put some stress, but you're getting a positive profit as a fraction of what you are spending today. There will be growth, but it will be very slow. But if it is zero, then the growth consuming capital without creating value, it's fine. Even then, I'm not questioning you because you're getting a bigger turnover without having any destruction. But if the gamma is below zero, that means if your credit adjusted profit is less than previous, this is the only case, or the cost has become huge on it, you are destroying your growth. That means you are reducing the ultimate position of the picture. Ultimate position, I've told you, debt trap, credit, business trust loss, debt trap, or erosion of capital. These are the final signs of business, and these are like heart failure, brain failure, lung failure. So that's for my business. These are the failures we cannot recover from. So we can give CPR to a heart failure client, but the possibility is always good in a medical drama, not in the real life. So again, revenue rises from 10 to 20 crores. Credit adjusted profit is more than 2 lakh. Capital stress of 40 lakh has been put. So the gamma is 0.05. So revenue growth does not guarantee business growth. So many startups today are presenting them very they many people ask questions that how why suddenly this startup started behaving differently from customers, why suddenly they came into high margins, why they're having high profit. Let me tell you one very simple situation. Many people are today's startup ecosystem is actually at a very negative thought process. They are thinking that they will create a market and then they'll start consuming profits. Actually, the level of capital we have today, the ease of information technology, if they get expensive, there is a cheaper alternative. People know about it and suddenly all shift onto that. In today's infrastructure, the road infrastructure, the entire country, including the IT infrastructure, it is difficult to create monopolistic competitions. So it is better to have consistent growth rather than in. So by the way, this will bring us to the end, last metric of financial capital, commercial integrity ratio. I've saved it for the last. This is something which you have never thought of. How much negotiated value survives execution? So this is actually whatever price you're able to charge was your negotiation starting point. What was the initial price that you negotiated, right? And what, like, this is negotiated price means where you started the negotiation, but I'm saying negotiated credit days is what credit days you offered and what actual credit days the customer took. And then your phi has to be price integrity into credit integrity. If it is more than 90%, which is zero point 0.9, you have a commercial discipline. This is the derivation simple. Zero point 0.9 and above is commercial discipline. 7, 5, and 9. Okay, you can change this interpretation to a little margins. It will say in the same direction. You can make it zero point 0.8, zero point 0.6 if you just want to, bring it more suitable to your business. But this is where the interpretation will say more or less the same. Margin stress, growth quality risk, and commercial breakdowns. So if it is below zero point 0.9, that means your actual price and your actual credit days are hitting your business hard, right? If that is happening, trust me, something or the else is going massively wrong, right? And please don't try to put it into a commercial into formula. First calculate this, and then we come to this. This brings us to the end of the financial capital of your business. Now we move to the uh, parts which are the invisible parts, which we say invisible, but I'll surprise you today. I promise you. These are the questions you have to ask. I'll summarize them on the presentation once again. Don't worry. Now, let me blow off your minds. You've not thought of these capitals as an objective principle. You've always heard them as a feeling, as an analysis, as a judgment. But Albert Einstein said one thing very clearly, that if you can't explain what you have known, you don't know that very well. So if I can't explain a normal layman or a child that how does this affect business and what is the calculation that runs behind it, do I really understand it? I don't think so. So when I say for trust capital, there is so many things: customers pay faster, vendor extend credit. Okay, how do I know what is faster, what is slower? There needs to be a math working. So the first metric T1, which is the trust capital one, sixth metric we're learning today is FO. Sorry, it's row. It's not row. It's not. It's row. Referral trust gradient. So how much trust weight is there? So if somebody is referring a business of equal or smaller size, that's not a trust that is being developed. So they know you can do their work. They're referring to a smaller or a little equivalent business. Zero is also an option, by the way, here. So they're not referring any business to you. So if my $100 rupee client refers me a 150 rupee client, he has a trust weight of 1.5. If a 1 lakh rupee a year fees client is referring me a 5 lakh or 1 crore rupee fee client, it is just referral. I'm not saying it converted. He referred me there. There's a difference. If that is the trust weight and I multiply it by the total number of referrals, I'll get my row, which is the referral trust gradient. If people are referring me zero business, a little smaller than them, which is if I have 100 clients, if I have a clients with a revenue of 1 crore and I'm only getting referrals less than 50 lakhs in a year. I'm not saying they're converting, but at least you're being referred. That's a big question. If that is the case, then the trust is weak. Between zero point 0.5 to 1, it's a basic trust. Between 1 and 2 is a strong trust. If the number of customers that you have, they are advising you beyond twice the number of, you know, twice the amount of business. So what we did is total trust weights. That means let's say 50 referrals were there. 50 referrals came from 50 clients. The total of their weights, more than one is very much possible. Two, four, five is also possible. And the total number is 50, consistent. And when you divide that, if it is more than two, so 100 rupee, sorry, 1 crore clients are referring you business of more than 2 crores. This is high advocacy. This is not strong, this is high advocacy. People love your work and they're telling your name like anything. You have had brand ambassador sitting in your client closet. That's the level of trust you've built. More than twice the business that you do, you're being referred for more than twice that. Reputation is compounded if it is thrice. 100% growth is for taken because, let's say, 1 crore client referring 3 crore worth of clients, we are actually at the easiest, a user refers another potential customer, chances of conversion are more than any other mechanism, except if the government who's send them to us. But that's a different business type, right? If I'm not wrong. So this is the referral trust gradient. I have converted the trust that your clients have in your services, your excellence, your professionalism, your pricing, your behavior, your approach is converted into ROW. Referral trust gradient. This is how you can measure trust that people have in your service quality, pricing, and your ethics of business. Going further, simple mathematics, nothing much. Then we have the second metric, which is tau. This is the symbol. By the way, these symbols are Greek letters, just nothing fancy about them. They're just there to make things easier because normal English or Hindi numericals would have not been very comfortable to define in the end. So, consequence trust index. That means if somebody is making a commitment to me, so I'm going to say a small line which we read a lot. At least in North India, we in the Hindi speaking states, we do read the Sundarkand a lot. And in Sundarkand, we say that, even during Operation Sindhu, that one of our forces person also said that, Bhai bin hoye na preet. That means there is no love without fear. So there should be a fear of losing you as a vendor, as a customer, or whatever. That how seriously customers treat their commitment to me, to my business. Maybe out of fear, maybe out of respect. But if they pay me in 40 days and they agreed to pay me in 30 days, dividing it by agreed days, I have 15 upon 30, 0.5 is my commitment variance. So there's a 0.5 variance in commitment. Half of the commitment has been varied. Negative side is okay, positive side is bad. And then we have the years of relationship. This is the maturity of relationship. And the order value is actually the weight. So the consequence trust index is 1 divided by the summation of all of this. So the more is, the more is worse, but this is a typing mistake, by the way. This is 1 divided by the entire submissions. Guys, please correct the material that you will get. This is page, if you guys are noting it somewhere, page number 21. This is not minus, this is dividing. You have to divide this, not to subtract. So 1 divided by the summation of the commitment variance into the order weight into the relationship maturity, then divided by the order weight into relationship maturity. And if that is, this is more the better, so we want to convert it into More the worse it was, so more the better. To make it more the better, we did 1 divided by the entire number. This is how I derived this mathematics, because I wanted to get up. Ultimately the score has to be 40, so this is how we have worked out the mechanism. Okay, I hope you guys don't mind. This is just uh, an accountant mathematics. Come on. So if my tau is more than 90%, point 0.9, it means that I have high consequence trust. I mean, people do have, they do trust that there will be consequences of uh, not honoring their commitment towards me. And if half of your commitments are being abused, your relationships are being exploited. Even if it is your real relatives, even if it is your family you're working with, your relationships are being exploited. If people do not acknowledge their commitment towards you half the times, and I'm not saying it is only one, it is obviously there's order value, relationship maturity, and stuff like that. That's how you would interpret the level of consequence trust. How much people trust that there will be consequences of not honoring commitments. If it is bad, you might be losing not just on credit period, but people might be sometimes choose not to pay you and they don't fear any consequences. Moving on. There's a small illustration if you want to do. Agrees days 30, actual days 35, customer B, both eventually paid one respected commitments. 30 to 35 is respect to the commitment, 30 to 90. Trust is tested when customer honor commitments after receiving value. The strongest customers are not those who buy the most. They are the ones who keep their word, and even when they don't need to. So there are customers who no longer need to do business with us. This is their last order and yet it is paid on time. That's the kind of trustworthy people we want to be in business with. This metric is more about the trust which we would have on our ecosystem, on our client portfolio, of course. Now we're moving to some great territory. Market confidence index. How much confidence does market hold into you? That is mu. So this collection friction, things like that. Now these are the behaviors. So the components are collection friction. So how many follow-ups you have to do before you receive your payment? How much additional credit has been granted to you over time? Like let's say first time you go, the credit amount that is being granted to you, or the credit which is given to you, was 10 days, 15 days, now 30 days, 100 days, 2 years. This is the level of expansion, the credit expansion you've had. Not using, but you are being offered. What credit terms would credible suppliers offer today? So this is vendor interest, not saying the spam email. Like how many serious vendors are proactively seeking a relationship? I'm not talking about the spam emails. I'm talking about serious vendors giving you serious letters of confidence, giving you serious offers of price and everything they've shared with you, and still they want to work with you. So this is the level of confidence you've built. It's a small 20% weight. So if you see, this is 100% weight given to the total, but higher weights are given to the collection friction, like how many follow-ups are being required for you to collect, and how many credits have expanded, how much vendor confidence has increased in you, and how much vendor interest is there. Then you get the mu. Mu has a problem which, if it is lower, market is skeptic towards you. This will end up on a graph. It should always be onwards and upwards. That's the only thing I can say about mu. It should be high, very high. Being a market magnet is a dream. I hope you guys achieve that dream. So if you have to repeatedly negotiate for credit, or otherwise you get approached with saying, sir, you pay us in this time, we give you this credit period. That means you're a market magnet. People want to work with you. What is happening? You're getting money, you're getting funded without even asking for it. Right? We have insights about every metric. Then we come to XI. XI is trust recovery coefficient. Now, this is important for service organizations. CA firms, listen up. Not for your clients, listen for yourself. All the other of my fellow business audience, please listen to this as a very important mechanism that mistakes will happen. There are events where trust will be breached. You'll miss deliverables, there'll be partial failure, there'll be legal notices, pricing error, delivery failure, relationship no. Give weights to these events. The trust deficient, the sigma of event weights is carried on the recovery events. So this is trust. So sorry, trust deficiency. So sorry, I mistakenly have. I need to verify the notes that I wrote down yesterday. So you calculate the TDS, then you calculate the trust recovery variable, and then after that you divide them. So trust recovery is simple that if the customer has returned, if there's a larger assignment awarded, referral has been given, price has increased and still accepted, strategic engagement is continued. So what happens is sometimes you miss deliverables, even after that, the customer comes back. Sometimes they still refer more clients. They don't work with you, or maybe they still work with you, still refer clients to you. These are recovery events. So we give multipliers to them. Now, these are some things which we have to, like we do for the clients. We give multiples, we give multipliers, and then we give multipliers to all this. And once we have given the multipliers, we submission them all, and we have a total mechanism of Xi, which is trust recovery variables upon trust depleting situations, or maybe something. It's not situations, I'm sure about it, but then I have to just, get back to you with the right word. If it is half of your clients, like most of the clients where you make small mistakes don't return, at least half of them, your trust is collapsing. If less than all clients who will give out are okay, it's fine. But if it is one, that means almost the number of clients you lose, they come back. If it is above one and two, how will this happen? How will trust be compounded? Well, this is when they refer more clients and still there's addition. A customer leaves, test competitor, returns and awards a larger assignment. That means the relationship is not merely recovered, the trust has actually increased. So this is where I give a bigger variable to customer returning after market, after they doing competitive, after doing competitive recovery. So that's why I don't say trust failure is always bad. It should not happen. But if it's a trust breach and you're able to recover from that, nothing better than that. Let's move to the epsilon. The epsilon is the relationship elasticity index. How much stress can the relationship absorb before it breaks? I'm sure you're remembering your college girlfriends and boyfriends, but that's not the time for it. But that's exactly what we're doing right now. So remember, calling your girlfriend or boyfriend at the middle of the night, even when they have families on their head, you're still saying, no, you talk to me. Talking is important. What exactly was happening out of talking? You were just pulling out the elastic. Why your friends, especially this happens a lot with male friends, women will remember something. I was never a part of a women's group, so I'll have to ask other people. We have a problem where most of our friends will call us out in the middle of the night, or maybe 8 o'clock. If we all have curfews. I had a curfew of approximately 8 o'clock at my home, I remember. So my friends will deliberately make it a point that they'll return. They were not very interested in meeting me or talking to me when it was 8 o'clock, when it was 7 o'clock, 6 o'clock. They became instantly more interested in me when it was 10 o'clock, 9 o'clock, 11, 12. Why? They were just making a stress test. That how much stress is this relationship taking for you? So, what are the stress events of a business? I'm sorry, I went into the college discussions. I do get a little carried away. But let's talk about the epsilons. The stress events of business is price increase, you reducing credit period, if there's a temporary delay in delivery, if there's an error in your service, if the competitor if the competitor has approached them. Just give me a moment. That was just an alarm for my medication. Just a moment. Apologies. So how will you evaluate them? So how many price increases as a client survives this price tolerance? How much credit tightening has the client survived this credit discipline tolerance, CDS? How many meaningful mistakes, not a small mistakes of saying good morning when it was 12:30. A meaningful mistake has this client survived this ETS, the error tolerance. And how many times the customer has stayed with you even after having cheaper or equivalent opponent or competitor outside. This is competitive pressure tolerance, CPS. And how long has the relationship been? Epsilon is nothing but a total compound of all of them. So we multiply it. This cannot be given a score, but we have to give it scores according to a higher or lower based on our own understanding. If the epsilon of a client is very low, it's just a transactional relationship. The day they'll have a better option, they will move and they will definitely leave you and go to a better supplier. If it is moderate, you have a commercial relationship, keep your terms at peak. They will not go for small problems. If it's high, it's a trusted relationship. Very high, you can start, betting your business on them. There's a strategic relationship. This is the difference, as clear as I can make it. So customer A, customer B, we have seen customer B demonstrates the strongest trust capital. Customers do not prove trust when everything is going right. Customers prove trust when they can continue the relationship even after things become uncomfortable. So the strongest relationships are not those who survive experience stress. They are the ones that survive it. So that's it. I mean, I'm sorry, it's not marriage advice, by the way. Don't take it as marriage advice. I'm not a good advisor on that circumstance in any way, choice. So this is the trust capital is not a marketing concept. It's an economic asset. The modern day is too much involved into TED Talks and into motivation that they have forgotten that ultimately you'll have to boil it down to simple mathematics. Simple terms have to be talked about. That simplicity is more attractive. I know if it's a little boring for you guys, I'm really sorry. I do apologize. That's exactly how knowledge can be delivered. I don't know better ways to do it. Then the human capital. So I asked a question yesterday that not yesterday, I think from 1 week I've been asking on my LinkedIn and my other social media platforms that which is the most important capital as per you. I'll be delivering a session on this on Friday, and I promise to put extra interest in there. And most of my clients, my friends, my family members said human capital is the one we value. I appreciate you. I appreciate you for acknowledging that human capital is valuable, but I am a little surprised. I'm a little skeptic that are you actually clear on what human capital is, or is it just another marketing hoax? So the question is simple. If the people sitting in your office change tomorrow, how does the business continue to improve? Right? The most important, the first part, you can learn about the human capital, okay? Then we move to the first and foremost, which is phi h. So because we were running out of symbols, so I just put a phi h here. The human metric is the founder's gravity index. Many people say the founder being involved is too bad. If business, you walk out of business 30 days, stuff like that. Sir, business is not that simple. Founder missing for 30 days will have a bad impact on business. How bad is the question? Na? Not if there's a bad impact, oh, you're a founder dependent. Sir, we know. Let's understand. There are five critical functions of this any business. You can have more critical functions and assign weights according to you. I've taken a standard matrix of all MSME startups and all the businesses which are 100,000 crore turnover. I think can take care of it. If you are more than a pretty Fortune 500 company, I can design a different mechanism. Normally, we have five functions: sales, collections, operations, finance, and strategy. Okay. Admin can be somewhere with finance. Okay. I assigned some weights to it. Sale is the 30% part. 30% of business is running. Sales is an important function. Collections is again important in today's day. Indian scenario, payments are so bad that collection is almost as good as sales, but still 20% weight to it. Operations are 20% weight. Finance is 15%. Important, but yes, can be, we can have lesser weights to strategy and finance. Now, we will take total activities of that department. Sales, let's say there are customer acquisition, there is 5 or 6 steps to it. You have to make the first call, you have to start, you have to explain, you have to close the deal. If the closing of the deal is being done by the founder, rest everything is taken care by the team. So 1 out of 5, not bad. The founder dependency is 20% and at a weight of 30%. So the contribution to pH is zero point 0.2 into zero point 0.3, somewhere around 0.006, right? The founder gravity index is exactly the total founder involvement into the weights of these activities. It is 5H. If below 20% is the founder's involvement, that means it is a distributed organization. It's fine. The founder can be involved up to 20%. This is what I'm saying. If the founder is not relevant to the business, he would not have been making the most money. That's what I'm trying to explain to people. Many people who are becoming founders think that they will make money on autopilot. I'm not saying you're wrong. You will make money on autopilot very, very soon, more sooner than you have been imagining from the last few years. But, my friends, my colleagues, my fellows, the truth is that 20% involvement is not bad. 80 is being handled by the team. Maybe it's a 1,000 people team and they handle 80%, and a one person is handling 20%. He's a founder for a reason. He makes the most money. If it's 20 to 40, still your organization is managed. So if less than half of the business is where you need to be, or it's a managed organization, it's okay. The founder is to be busy. They have not yet cracked the game. This you learn in knowledge capital 5 minutes later, 10, 15 minutes later. I think this is the first metric. No, no, no. It will take at least 10, 15 minutes, okay? And then if it is 50 or around 50%, it's founder centric organization. Still not dependent, but it revolves around it. Not very healthy, but still amber is the zone of it. 60 to 80 becomes a founder dependent zone. So this is founder dependent. If the founder goes out, business more or less is gone out, is not working very well. Above 80% is the founder gravity collapse zone. So if the founder is sick for 10 days, he's hospitalized, I promise you this organization will fall down to the graves. That's a bad thing. So this is again the more the worse, right? So again, 1 divided by it, and then we add to the major score. Here we go. There's an illustration, revenue 50 crore, founder dependency 85%. Revenue 10 crore, founder dependency 25%. More scalable is the business number 2. I promise you. Because you know what? Of course, he, like, if I say 50 crores, 85% is being done by one person here, 1 or 2 people. They have limited that they can expand. So the scalable portion of this business, the revenue, is just 15%. 7.5% is the scalability. Business B does also have a 7.5 crore scalability. So, but then of course, because it's less founder dependent, it will go further with a little effort of the founder, right? Founder gravity tells you how much the business owns the founder. So revenue might does not tell that founder owns the business, but how much does the business own the founder? So you know that founder owns businesses, but this index tells you how much the business owns the founder, not just time or other things. Now let's go to beta 2. Beta 2 is organization's resilience index. So let's understand. My thing is that am I working at absolute capacity? Like if 5 employees leave, how much will my organization survive? So if I fire 20% of my workforce, how much will my organization perform? My question is, I always say 80% performance still makes sense. So 80%, to perform 80%, how many people do I need? This is a simple thing to say. So if I make 100 rupees sale today, to make 80 rupees sale, what percentage of my people can I fire? Or not fire, they can go on a holiday, they can go on a leave, they can get married, they can get pregnant, whatever they want. But how many people, how much percentage of my team I need to function at 80%, right? So first of all, assign department weights. For me, 35% is operations. They import. Sales is 25%. Finance is 15. Procurement 10. Admin 10. Support functions 5. Drivers, peons, and everything. Weights. Let's be practical and not emotional, right? Determine the survivable employee loss. How many employees can leave before department efficiency falls below 80%? So employee losable divided upon total employees in that department. So this is the DSR. Now, what is the organization resilience? This has to be calculated for all the departments separately, right? So, if the organization resilience is the DSR into the weight of the department, and summation of that is beta 2, less than 10%. If to perform at 80%, you need 90% of your staff, you're a fragile organization. If you need 80 to 90, there is break even, but there is not proper resilience. If you can perform with 65 to 80%, 70%, 72% of your staff, you're operationally stable. But if half of your people go today, or a little less than half, you're a resilient organization. I mean, half people can be off, so you're ready for emergencies, you're ready for breakdowns, you're ready for social emergencies, you're ready for physical emergencies, a pandemic, a lot of things you're ready for. That's what I want to say. And if it's above 50%, you're an anti-fragile organization. You are like a cockroach in a nuclear blast. I'm not sure if cockroaches will survive nuclear blast. That's what I hear. Right? 100 employees in company can lose 5 and 40 employee company can lose 15. Traditional analysis covers favors company A, but human capital analysis favors company B. Now there's a very important, there's a small issue here. In this case, these will be somewhere self interchecking matrix. So beta 2 will be sitting on phi h and they'll be questioning each other. The organization resilience has to be good, but so has to be the founder gravity. Just because we can fire employees, just because we can do it with less number of employees, it should not mean that we become founder dependent or a founder collapse zone organization. That's why these two are important to have. That's why the entire mechanism is important to have in the. If you're having this analysis in your organization, trust me, you need the entire system. You cannot just take 2 or 3 ratios and they'll give you a good result. This is an entire mechanism you have to follow. All right, the talent retention cost factor. First is the retention ratio. How many employees have you retained? 100? Best? Less? Okay. Then, how much compensation are you paying? Divided by the standard market compensation, which you can, of course, you need research for that, but you will have this amount. Then the talent cost factor is the maximum of the compensation premium that you're paying or the replacement cost. This is replacement cost. So RC, please make a note, everybody. This is RC is nothing but replacement cost. Okay. Now, talent retention cost is actually defined by theta. Theta is replacement. This is basically retention ratio, which we said employees retained upon that. And what was the talent cost factor? We have to take the more of either the premium that we are paying or what is the hiring cost that we are coming into. What is the replacement cost? If replacement cost is more than the market price, it is I'll tell you the reason. My organization is based in many of you know Noida, Gurgaon. Let's say Noida. My organization is based in Noida Sector 135. Very less employees are nearby there, so more employees are charging just because they are coming far away. So even if the market price of other for other firms is 10,000 rupees, for me it is 15 because the employee is adding the stress and time he has to spend to come to my organization. That's fine. So that's why I'm using the TCF instead of one particular stringent method. So that's theta is retention ratio divided by the TCS. People have been calculating the retention ratio, but until you calculate the effect of cost on it, how much money you have to spend, what is the outcome of that? What is the mathematics there? It is just a feeling. I have a better retention, I have a worse retention, you have a better retention. Why? Maybe I have a great retention, but I'm paying boatloads of money to it, right? If more than 90%, you have a sustainable retention. So just you're not retaining people by paying them more. Remember, if it is more than 90%, you are not paying them by just paying them more. But if it is below 40%, how long can you survive by paying them more? Just because you pay more, just because you hand out money to every leaving employee, this is not a good retention strategy, I would say. And that is why today you see in corporates, many employees keep on switching jobs and they start increasing packages. Actually, they're not switching jobs and increasing package because stability is not rewarded. They are going to an organization which has more value for the same service. The other previous organization does not have that kind of a replacement cost for them, or maybe the current compensation for the role they're hiring them in is not that high paying. That's fine. Think like a businessman. So retention is 100, 40% compensation premium. Retention is 90%, but they don't pay any premiums. Business B may possess stronger human capital. There is other factors that are keeping employees engaged and not the compensation premium. Retention is not impressive if it must be purchased every year. If you have to buy retention every year, it's not an impressive retention. The objective is not to keep the employees. The exact objective is to become an organization which is difficult to leave. And I'm not asking you to be a psychopath and tie your employees in your basement, just in case. And of course, we've got the second last metric of human capital, which is capability accreditation index. This is very simple. So you have to calculate for first thing is just identify the critical skills. In my organization, we have ITR like ITR 1, 2, 3, like auditable, accounting document, ethics specialist, aware of the process, closer, signing partner, whatever you want to call them. So these are different skills that we see. In sales, here we have seen three: negotiation, closing, and CRM, quality control, planning, reporting. First, you organize it. Now assign the levels. 0 is no capability, 1 is basic, 2 is working, 3 is independent, 4 is advanced, and 5 somebody is an expert. So now the entire employee, all employees will have score 3, 2, 1, 5, 5, 4, 3, 5, 4, 3. So now just sum all the current year's talent, subtract the same talent pool from previous year, and now adjust for the skills of employees that you have hired during the previous year. Your capability, because you have to adjust for external hiring. No, external hiring is not what we have developed in our organization. So that kappa is not our kappa, it's somebody else's kappa. This is kappa, by the way. Now the kappa is the current year's skill pool minus last year's skill pool minus the external hiring, the gravitas or something, divided by the skill pool of last year is the capability compounding if 40% skill pool has increased in 1 year. If it is between 20-40, it's a learning culture, no problem. 10 to 20, you're improving, but we want to reach here. This is dream. 0 to 10, that means your organization is static. Whatever the person was doing last year has been doing this year. And this is not a question you need to ask employees. You need to ask your own organization why the culture is not there to learn. And if it has gone below 0, I'm sorry, capability is being eroded. And there's one small problem. We do not adjust for attrition here. So if employees are leaving, they will not be adjusted anywhere. So that means this has to survive the test of the attrition as well. So it's okay some employees are leaving us, but skills should not be going out at that pace. So let's say 2 employees left our organization level 5, but 7 employees of ours climbed 2 levels in that year. It's okay. 14 addition to 5 to minus 10 minus, it's okay. We can survive that. Right? So hiring capacity is easy, creating capability is difficult. Yes. Training measures efforts, capability measures the results. And we do not, the real world does not reward efforts as much as we want to. Only social media rewards efforts. Right? All right. Moving on. We've got Zeta. The last metric of human capital is knowledge transfer efficiency index. This is interesting. The question is simple. If you are moving from one to another, I've filled the entire paper. I hope you guys are writing too. I've filled so much while explaining. I hope you guys are writing it down somewhere. So if the just give me one moment. Something wrong. All right. So have you ever wondered that how will we maintain this attrition without having additional cost burden on retention? Well, the reason many big organizations do not, still function efficiently, even if employees keep on leaving them and they still keep on coming, how are they still able to sustain it? Because their knowledge transfer is efficient. And how do we calculate it? We calculate the growth of that. The efficiency is an index of how much does it grow. How much time did it take for one person to be onboarded this year minus last year's time? How much time was it taken to validate an additional skill and how much it took last year? Then, how much task is trainable only through SOP? Like anybody can come, a good corporate trainer can come and train it without any internal culture or skill awareness. Just using the SOP, they can train them divided by total task. This is the external transferability factor. Now, Zeta is difficult to calculate, but I'll still tell you. First, training time, multiply it by the skill validation time, and 1 plus the external transferability factor. The entire number will come somewhere which will justify the entire total will be knowledge transferability efficiency index. I know this is getting a little difficult territory, but read the book afterwards. I'll just give you the key learning here. So there's some additional reflection. Experienced employee is an asset, experience trapped inside an employee is a liability. Remember, just like an experienced employee is an asset, experience trapped inside an employee is a liability. The goal is not to retain knowledge. The goal is to transfer the knowledge of this matrix. What if the most important employee dies tomorrow? What exactly is our plan of action then? So, okay, we've got some more fancy words on the same. We'll go to that very soon. Now, let's just quickly wrap up the knowledge capital. We've come to the end of this part. And we have to still learn that how will all these numbers come together and make sense. Don't worry. Don't worry. I'll take you through all the bits. Let's go to the Sigma. Sigma of knowledge index is the process codification ratio, that how much of the business exists in documented form. So What you do is identify the critical processes, sales, delivery process, collection, etc., whatever it is. Assign them weights. Now just see how many, first of all of them, like sales has 7 processes. 5 of them have a SOP, a special document where you can learn. 2 processes like customer negotiation, people do it with their own way. So we have got 5 upon 7, right? So 5 upon 7 is, so let's say 5 into 25%, 1.25, and 7 into 25%, 1.75. This is 0.71. So we are just doing something, we're just giving weights to documented process and total process. Like sales has 7 process, 7, and this. We will take it like a big ratio, like sales, delivery, and we'll do this again and again for all the processes. And once you have the submission of it, you get the sigma. And if the sigma is below 25%, 0.25 say low, if it's lower than 25%, the knowledge dependency is on people and not the written documented procedure. Between 25 to 50, you have basic documentation, but still more improvement is required. If above 90% is there, and many big organizations target health, if you're not tracking this, how do you imagine this is happening in your organization, right? So this is simple stuff. Moving on. Decision capture index. Again, knowledge capital has, like, you identify critical decisions, major client wins, major client losses, things, important parts, and how many of these decisions have review notes where you can learn about them, lesson learned, process improvement, record reasoning. It's just like audit documentation, but a little more fancy. Every time something goes wrong, we should have documentation. The documented decisions, these are critical decisions, right? And how many total critical decisions happened. We have to be very conscious. We have to have a separate thought process for this part. And the delta will tell us that how much of our business is being documented. If more than 90% is being documented, you have an institutionalized learning system. So you document your mistakes, your wins, not just bad things. You document good and bad, both things. And you have the answers to the why to everybody taking over. This kind of data makes even the CEO as replaceable. Even CEO can be replaceable in this organization because the entire decision making is, completely institutionalized. So that should not be a problem. Just give me a moment. Yeah. So experience is not what happened, but what was recorded. I do want to talk about, you know, you should move further. I have a lot of stories that I want to share. Archimedes, some related to Renaissance era, but then we'll have some other time. I'll talk on better videos on that. But there's a very important thing that, you know, many great philosophers never wrote. They thought the knowledge should be discussed and not recorded. The only way we know those people is through the records that were made by their colleagues and their allies. Documentation is important. The third metric, simple knowledge accessibility ratio. Can employees find answers without finding people? So, first of all, test. Identify top 20 most common operational questions. How customer is onboarded, how refund is processed, how is the purchase approved, how is the GST filed, how is the e-way created, how is the e-way made for a 20-kilometer range, how is the e-way avoided without in 50 kilometers, how do part B is avoided. Basic questions. If there are 200 questions like this, 20 is just a way of saying if there's top 20 questions that come every day, how many times people answer them through systems is the test. If it is more than 25%, still there is accessibility of knowledge. But if more than 20, less than 20, look, there is questions. Where do people look for questions? I'm not saying people know the answers. Who know the answers, that's not my concern. My concern is if they don't have the answer, where exactly are they looking? Are they looking into a database or are they asking left, right, and center? If they are asking the database, if they have a knowledge management tool, nothing better than that. And this is defined by the way, lambda capital. This is capital lambda, and this is telling you the knowledge accessibility ratio. Finally, so if employee asks, how do I process this? If business A, he says, find Sharma ji. Business B says, search the knowledge portal. The second business scales better, I promise. A knowledge system succeeds when employees search documents instead of people. And even today, when everything is available on Google, YouTube, almost entire CA curriculum people try to cover through YouTube. Why have we not still experienced employees reaching out YouTube before the founder? Because this is the level of dependency people have. Because this is not knowledge which, how to do a thing is not important to an employee. How does the organization want them to do that thing is important. You find YouTube videos, make a library and put it into your firm system. People will start using them. But you ask them to take this judgment, they're not asked. Many employees in scaling is failing because people don't want to take judgment. Decision fatigue is the biggest fatigue they're facing, actually. Right? Moving on. Fourth metric is always omega K, which is how much knowledge has been embedded into systems. Simple. Follow ups are automated, invoices are automatic, ERP controls things, approval workflows, compliance alerts, things like that. So, whatever is the weighted automated knowledge tasks upon total knowledge based tasks. I'm not saying all the tasks, but the knowledge based tasks, follow up, stuff like that, people have to do it with knowledge. Again, if that divided is again, we have 20% manual intervention, above 80% system led organization. Always move towards system led. I'm just trying to move fast here because we need to cover up the rest, how to follow this mechanism as well. Last one is very easy, replication speed index. So, if you want to open a new branch, create a new team, launch a new location, add a product line or establish, you have to measure the target replication time versus actual replication time. If you have to create something new, if the target time is more than the actual time, the knowledge is scalable. That means actually you spend less time, but you had a higher time available with yourself. But if it is less than, you took more than like 33%. If it is below 0.75, that means you took one third of the time extra that was budgeted. There is replication difficulty. So if you planned for 3 days, you took 4 days, it's a replication difficulty. Things are going south very soon before you know it. Business A requires founders' presence on every location. Replication takes 12 months. Uses documented systems, training frameworks, and controls. Replication takes 4 months. Knowledge capital favors business B. Key insight is business is scalable when knowledge can travel faster than people. The test of knowledge is not whether it exists. The test of knowledge is whether it can be replicated. That's all the ratios you've learned today. I appreciate you all. I've put in all the ratios and how to call these symbols as well. I know it's difficult for people. In this booklet, you'll find everything. Then the 20 questions that you will answer. Now we'll take you to them. So this is a 59-page book summary, which you will have to be, of course, you'll be reading. I hope you guys you take benefit out of them very soon. Now I'll be sharing the presentation again, and I hope that now quickly I'll tell you how to use this entire framework. Right? Give me a moment. We've already covered this part. We'll also summarize all the things that we've discussed since morning. Do we remember all this discussion? Yes, we do. We remember the case studies we took. Just like that. Sorry, when you have animations, the biggest irritation is that they don't move as fast as you expect them to. We started with the IBT framework. Of course, the financial capital we discussed. Can the business survive its own numbers? Now I'm just going to quickly see and discuss what questions have we answered at every particular slide that we have seen today. We already know Lambda was answering whether the business can survive. Lambda was a simple thing, liquidity strength index, which said, can the business survive in a long run? When we talked about psi, it was, does profit survive the credit period which we are giving? It's an important metric, which I've, and trust me, it has become more important than any other thing in the Indian current business scenario. When we said omega 2, are we dependent on customers, or customers want us to be like, are we dependent on one or two customers, or do we have a scalable business in our hands? Then we talked about gamma, the growth stress efficiency ratio. Is the growth helping us, or is it becoming our cost? Is the growth actually hurting us? We discussed how much value survives execution. Like when we saw that we were discussing the phi, that when we execute, is the survival still sticking to the execution that we do? Then we move to the trust capital. Will relationships hold when they are tested? This is a bridge. It will be tested in a bad weather. Will it hold? The question is easy to answer theoretically, but less. What we did is we made it a row, referral trust. Our customers bringing us new customers. We have mathematics for it. Then we said tau. Is the relationships endure over time? Are the trust increasing even after consequences? People are ready to accept consequences for you. Then we discussed mu, which is market confidence index. How many vendors want to work with us? We call the shots when we have more incoming than outgoing. Demand and supply, very simple. Then we talked about Xi. Can we rebuild trust once it breaks? Can we rebuild trust once it breaks? Trust recovery coefficient. Then we had epsilon, which is relationship elasticity. How much strain has the relationship absorbed between you, your client, your vendor, wherever you want to trust it? Then, can the business run without the founder? That was a very important question we answered in human capital. First, 5H, does the business orbit one person, which was founder gravity index? We discussed that in detail a few minutes ago. Then beta 2, does it stand if the key person leaves? Organizational resilience index, we were removing people out of the organization and seeing how much survival we can do. Then we had theta. What keeps our best people here? Not the money. We know it's not money, and how people are still staying with us, which was talent retention cost factor. Is it just the money that's keeping people here, or do we have something better to offer? Then kappa was capability accreditation index. Are our people growing in capability? Our in-house force, the talent pool, the overall talent pool graph should look like this. If it is not, the questions should be asked and efforts to be made before it turns into a debt trap, capital erosion, big signal, right? Then we said zeta. Does the knowledge become shared systems, or is it just a one person's property and we are using it? Then, of course, we moved. I know people have favorites. I have favorites. I'm not supposed to pick sides in my own research, but I don't know why. I like to work with organizations who are succeeding, who have the mindset to succeed. And if I can say one thing, right? If I can say one thing, it was my favorite capital index to calculate. It took me a lot of efforts, a lot of hard work to get to this knowledge capital. I got Sigma, which was documents become a repeatable process, process codification. If something is happening, is it becoming a process in our organization? Then Delta, decision capture index. Mistake, I think this is a question, but I showed you mistakes and also good things. They should become lessons for future. Lambda capital we had is know-how findable without a person. Are we ask knowledge accessibility ratio, like are we finding a key person, or are we working, we're able to access the information through systems or knowledge portals, or connected knowledge. Then we had omega k, automation leverage index. Are manual tasks becoming automated, or we are still getting into manual tasks again and again? Last was 5k, can we build can what we have built be replicated? If we have made it, if you want to replicate the entire team system or whatever, can it be replicated? This is by far, replication speed index is by far ready to pick sites. This was my favorite ratio to calculate. I wanted to document, like, let me just be very honest with you. What I said is, I wanted to document the replacement. But then, when I was able to do it, I was on cloud nine on this night. This is around a month ago when I was able to derive it. So a business is scalable when knowledge can travel faster than people. These 20 questions together form the invisible balance sheet that we started the session with. These are the keys that will come out when you do the research. I promise you, these 20 questions are your invisible balance sheet. That's it. The 20 points. These are the 20 parts of the invisible balance sheet. And there is no credit or debit here. It's a one-way mechanism. Moving ahead, moving ahead. Chani, we still have a few things, like we still have how to just go about it. And I'll do it in 5-10 minutes. Won't be bothering you too long. One
Sure.
moment. So how do we follow the IBT 300 challenge? Well, the challenge is simple. 30-day calculation, one cycle, 30-day. Once you can make it into an Excel. I have the Excel sheet if somebody wants it. We use it. We use more than 20 metrics when we do analysis. But let's say accountants, if you're doing it as a self analysis, you don't want to invest into a big firm coming in and taking over. 30 days, answer 20 questions. After 30 days, answer 20 questions. After 30 days, answer these 20 questions. Put it on a graph. 10 cycles. Invisible balance sheet tool, 300 days. Just measure the business. You will see not just one graph of 40 points. You will see every ratio moving in different directions. And that is the day you'll realize that I am able to sense something is good or bad. And trust me, even we give signals to the business. Where do solutions come from? Entrepreneurs bring solutions. Accountants just point out. Moving on. Well, do not believe the framework. Test it, measure it, challenge it for 300 days. What gets measured improves. And what gets improved compounds. Right? So, traditional accounting measures the visible balance sheet. IBT 300 measures the invisible balance sheet. The visible balance sheet tells us where the business stands today. The invisible balance sheet tells us where the business is likely to stand tomorrow. Thank you. That's all. If you have any questions, Chandni, for me, I'll love to answer them.
Yes, sir. We
Thank you
have a
so
question.
much, sir. Thank you so much. It was such a wonderful session that we were not waiting it to end. And at the same time, we have our pen and paper with us. I think we'll have to do more homework. So now we will start a quick question answer session. We have got very curious audience with us. So the first one is, as a small business owner, how much financial capital is enough to start and sustain the business?
Very nice. I think this is a question for How much capital is required? I think when I started my CA firm, I started with a zero capital. I'll be very honest. It's also a venture. I ended up making a consultation firm. We don't have capital. I guess, Chandni, you're also into practice, right? So when we do
Yes,
our first return, we just have a small laptop, and sometimes they're using our firm's laptop. We not even have our own
definitely.
laptop. Just the clothes
Definitely.
on our body and the food we're eating is coming from our home, which is financed by our father. Except all that, we're business and capital questions can be answered specifically with an accountant when you tell them what's your business idea. Business can go on with zero capital. I'll give you an example. There is a commission agent standing outside every vegetable grocery market, right? He does nothing but he just takes the trucker, gets the fruit, the vegetable, the seller or maybe the wholesaler. He gets the deal done and he gets a good amount of commission paid right then and there. There is no capital invested. But still, there are super stockists of FMCG, the super stockists, they put in so much capital and we learned credit adjusted profit. Their credit adjusted profit is negative. So, what kind of capital you need depends upon the business. If you're in the service industry and your service can be given without a lot of equipments, like you're a masseur, you're a masseur, you can do it just with one table. If you want to start a
Yes.
parlor, you'll need more money. So that's very dynamic. I would love to answer the question, but then go to your nearest CA. Just appreciate the geography. We accountants are trained; they'll give the answer very perfectly. Yeah.
Yes, very well explained answer. Coming to the next one, what are the major mistakes people make while maintaining their financial capital?
Well, the most important mistake, this is just my experience. And I don't know, we have another practicing CA Chandni is also here. She'll add to my words if possible. The most important thing people make a fluke while doing business when they come into the industry. They try to kill competition by reducing prices. They try to kill competition by giving high credit periods. Both of them are traps. Lower margins are killing your own employment, your own expenses sometimes. And a bad credit period is increasing your bad debts as well. And of course, the cost of credit sometimes. So, this is a common mistake. And one major mistake is not investing in the finance department. It can be an investment of time, it can be a
Yes.
good chartered accountant, it can be a good expert master of business. Any good investment in finance comes after they are making 100 to 200 crore rupees a year as a revenue. Accountants need to come in pre-revenue. Like I have consulted startups all my life. I have been with startups before they were at idea stage, and found the investors respect that you have a CA with your side. I mean, it's not like how it happens on TV. It's in real life, they appreciate you have a say. We can actually create financial models more particularly. If you don't want to pay a CA, at least invest in your own knowledge. Increase your knowledge, be a good accountant, and investing in accounts late, killing the competition, and most importantly, trying to give external extensive credit periods. You're just attracting bad clients, nothing else, bad customers. Yeah.
Definitely. And I think I would like to add that there is no clear answer to it because there are n number of mistakes which could lead to financial capital loss. Like you clearly mentioned, sir, we have ideal example of that also, not investing on right people, I'll say. Be it your professional, be it your team. People prefer ki छोटे cost में we can hire somebody and take care of things and which lead to wastage of their own time as a promoter, और I'll say initially जो promoter होता है that is sales person for the business. अगर वही busy है अपनी activity में तो how they will expand the business. So I think that is also one of the reason. Moving to the next question, people are curious ki if they want to build associate with the bigger brands, so how they can utilize the trust capital or build their trust capital.
Good question. I said, you need to start measuring the referral trust index, the index which we made, which we defined with the row. The first metric, I think it was the first or second metric of the trust capital. You have to see, before you start approaching big brands, you have to see the ones you are serving, are they trusting you with a business bigger than theirs? Once they are doing that, that shows that they trust your abilities more than they can, they can deliver to you. How many of us have clients who are not even giving us their biggest account? That biggest account is sitting at some else firm, right? Same is with other businesses. Before moving straight to big brands, the climbing of the stairs is one by one. There's no elevator to big brands. I'll be honest. The only elevator is go work for a big company who serves big brands, come out with one client. This that seems to work, but honestly, just observe those professionals for 5, 10 years. You'll see them going back to employment. So there's a learning curve to it. When I started working for 10,000, 15,000 crores turnovers, I realized there's a different behavior that I had to adopt. They don't expect me to work a lot. The bigger brands don't expect Nakulora to be working all the time. They actually get very surprised if you're working for 5 hours in their organization. So they get skeptical of you. There's a behavior curve. They want documentation, they want emails. It's a
Yes.
different culture that will happen. So if you have to climb Mount Everest, no, Chandni, today you want to climb Mount Everest, you can't start at Mount Everest. You have to go to the Mount Friendship first, 6,000, 7,000, work up your way, and someday you'll be climbing 8,000, and then you go to Mount Everest. So you don't straight climb to Mount Everest. That's all I'd say. Develop your team
So
first, yeah.
we have another question associated with this only. So how does collaborations and partnership add to your trust capital?
Vividly. Collaborations, partnerships, but they should be meaningful collaborations. Now, meaningless collaborations, you both work in the same industry, same geography, just because you wanted to, just because you're nearby, you collab. There's no skill addition, there's no geographical addition. What exactly are you collaborating for? Like I sit in, like I'm in NCR, and because of the road infrastructure, NCR is accessible within 50 to 60 minutes, almost end to end. Mostly like I can get to Gurgaon in 90 minutes. So most parts of Gurgaon can be touched in 2 hours. So am I actually investing in anything except skill if I'm collaborating in NCR? No. The only thing I'm investing is the number of people. That's not the case. You have to have skill there. There has to be an addition of knowledge base. There has to be a geographical addition. So if I collaborate with somebody in Gujarat, somebody in Mumbai, somebody in South India, somebody in West India, that's where I'm making sense because I am expanding my geographical wings. The most interesting of those is just see the podcasters today. Earlier, when the podcasting industry began, and even today, the defense podcasters take podcasts of defense retired or veterans. But today, some podcasters call themselves professional podcasters. There's nothing like this. You're interviewing somebody from an, like for me, if any popular podcaster interviews me today, he does not have the right questions, he does not have the right curiosity to. So that's a bad collaboration. Good collaboration will be some accountant starting to, ask questions to me because they'll have more insights, right? So yeah, the collaboration has to be with something of there should be some synergy. The right word is synergy, I think. Something should be expanded. Yeah.
Yes, to summarize, if we are doing right collaboration and partnership, it will definitely add to our trust capital, or else it will be in vain. And some more questions related to trust capital are whether it is easy to build or maintain, which one is easier, to build trust capital or maintain, or if by any chance we break the trust and lose the trust capital, how is it difficult to rebuild the trust capital after making mistakes?
We studied a ratio called Xi. Because trust recovery coefficient, I remember. That there will be, and as a CA, I can tell you, we CAs, doctors, both of them have critical jobs and they still make mistakes, right? And we still have repeat patients and repeat clients. We still have people who left us because of a mistake. I agree and own up that there was a mistake from our end and they left us. And after a year or two, they come back at a larger exposure, at a larger expectation. Trust, neither it is easy to build nor is it difficult. It is just a process. If you're ethical enough, you're doing your business right. I just do one thing. I'm sorry to share this like this, and you can have any religious beliefs you want. I always say that accounting is a way of divine speaking to you about business. So always write your ledgers with a devotion, like devotion to the divine, that this is something I'm doing. My ethics should be invested here. I would give my best shot whenever I'll be doing in a consultation. If it is failing, it has to have a reason other than I did not want it to succeed, right? If your intentions are right, you're doing the right business, trust, except you're trying to create a hoax of trust, right? Like, for an example, there are two ways to be impressive in college. You can either have good spiked hairs, big cars, which you cannot buy, of course. You're taking your father's car or your uncle's car and you're, trying to be cool in the entire school and college. There was other kids in college who were doing studies at the time of studies. They had a job when they had to do a job. Today they have Mercedes and BMWs and whatnot, and they are living happily with their high school sweetheart as well. What went right and what went wrong? You're doing the right thing, you'll get it in the right places. But if you're trying to do wrong things and if it's a facade of trust capital, it will always break down. Facades, like if I wanted to give a presentation on this topic and I came before you by making a PPT within 1 hour, it would have fallen apart and either you would have been impressed, but after 2 months you will have forgotten about it. But trust me, this is 5 years of research. This is day in, day out, whiteboards, math working, math not working, and then this comes out. Even if you ask me to deliver this at any organization, they'll know right well, and this trust capital will sustain because I have created these ratios, so I know how these will work. And if there is a problem in the math, I can resolve that as well because I was the one who created it. So if it is a solid foundation, true trust, it will sustain. That's all I can say.
Thank you so much for the lovely explanation. Moving to the next question. Okay, one second. So, what is more important, having profitability at the start of the business or cash flows?
Well, it is like asking me what is the more important function at a marriage, a haldi or a mehndi. They have their own role. They have their own importance. Like profitability is important, cash flows are important. Like I come from if in case I come from a privileged family, I'll have cash flows, so I can, of course, wait for some payments. Credit is something I can give because I have cash flows coming from my father. I have some good money who's invested in this. If I come from a place where I need regular cash, like for my own bread and butter from the first day of business, I need money as an extra out. So there should be a cash flow is better. Some less profitability will do. But if it is a business who has to go longer, so if a credit adjusted profit is better with giving credit, I'll give credit. I'll reduce my margins. But the problem is I should have that cash flow for my business. So I calculated the cash runway for the business as well. That's a separate ratio. We did not discuss this today, but there is a way to calculate cash runway, and I can, of course, we can help people with cash runways. We do cash runways. I think Chani, you must be doing it for other people, especially
Yes.
for startups. We do runways, yeah. So depending upon if you have the runway, go for profit. If you don't have the runway, go for cash flow.
I think more or less these are very subjective and it differs from business to business and how they have their backup with them. It's all depends on that also. So whosoever has asked this question, I'll request before you decide for your business, if you are in business, make sure have a talk with your professional or somebody who can give you insight about the both the topics. Moving to the next question, sir, they have question: what is more useful, having an experienced hiring or training your existing staff or employee?
My first car was Honda Amaze, okay? Right? It's a sedan. For off-roading, no matter how much modification I do, it will not work.
I got
Right?
your answer already, but
Number
we'll
one.
still
Yeah. Yeah, yeah.
little details.
Number two, if I want to ride it on small mountains like Himachal, Uttarakhand, which we have roads, we can use the same employee and we can train it to a certain level. If the capability, you have to always be comparing. As a businessman, people want thumb rules. Thumb rules don't exist in this world. The only thumb rule is the math should work. Every time, like I told you, talent retention factor was there, cost of training is there. Like for me, if I want to have a partner as a CA, if I see this person sitting in front of me, I invest in his education. I invest in his make him a CA 4 or 5 years, and then also becoming a CA or not is not in your hands. I think at times I'm more stupid than the guy who's thinking that someday our neighbor will be able to pay off his debts. But if we talk about filing an audit report, and for filing an audit report, I hire from outside, which I can train within, let's say, 5 days, 6 days. Then I'm stupid again. It's always comparative. The cost of training and the time, the opportunity loss in that training time, and external hiring cost. Whatever suits you better in a long run, that will go better. The math should work. There's no thumb rule. There is no thumb rules in business.
So to summarize all the questions here and the answer provided by Nakul sir. So for
Mhm.
all these financial capital, trust capital, knowledge capital, and your decision making with respect to profitability, hirings, cash flows, it all depends again कि आपका business क्या कर रहा है, to what scale you are. Like for the last question we took, hiring versus having training in-house training. Again यहाँ पे दो चीज आ गई ना, whether you are training yourself or you are getting somebody hired for training. Then you have to compare your time value of money. Then if you are hiring somebody with the requisite skills, what is the cost comparison? So here, since I am also actively consulting many businesses in CFO capacity as an internal auditor and advisory, we see every month there is some changes in the financials. If not months, at least quarterly and half yearly, there are some changes, because business itself is a dynamic, industry itself is a dynamic. People in the same industry group, people in the same peer group don't have same level of revenue, same level of expenses. Direct cost ratio change हो जाएगा, other चीज completely depends on how they have funded their business, etc., etc. So there is no defined rule for it. So since we don't have many more questions, I would like to now officially give my vote of thanks to CN Akul sir. So, firstly, I'm grateful for the MSME committee to give me the opportunity to moderate the session, such an insightful session on Tavagat. And on behalf of MSME committee and our chairman, CA Gyan Mishra sir, our vice chairman, Sanjay Kumar Agarwal sir, and the entire committee and participants, I would like to sincerely thank Nakul sir for your valuable time, taking time for us and enlightening us. I would say this was not mind blowing session, it was mind blown session, because all of us have exercise and homework to do it. We all have been measuring things at our level, but your valuable input clearly shows how much efforts you have put. And this is like after 12th, we are again having a mixture of accounts and math in our curriculum, in our practice or in business for those who are from that field. It was clearly revision of so many chapters, I would say. हमारे अपने variance, probability, lambda, theta, सब कुछ आपने रिवाइज करवा दिया. So it was very valuable session, and we'll most likely to meet you. We'll like to hear from you again. जैसे आपने बोला, there are some other things which are not shared in this, but उस पे again अगर session होता है, we'll be very happy to have you again. Thank you so much, sir.
Thank you very much to the entire committee. Ravi, thank you so much for your efforts. You've really pulled off a great session today. Thank you. Thanks,
Thank,
Chandni. You've been one of the excellent moderators I've had in my life. Thank you. Thank you so much.
thank you so much, sir. Thank you so much, sir. On that note, we will conclude today's session. Thank you
Thank you.
everyone for your participation, and thank you committee and our technical supporter to maintain that the session goes in flow. Thank you so much.
Thank you, sir. Thank you once again for wonderful session. Thank you, sir.